Hey there, Brenna Bockham, Collective Wealth Planning. I am a certified financial planner and a certified tax specialist, and today I'm going to talk to you about giving appreciated assets to a donor-advised fund using a bunching strategy to help meet your philanthropic goals. That's a mouthful. And anytime we're thinking about going more complex with our financial lives, we have to start with why. Why are we doing this? What's the benefit? Well, with the standard deduction now at $14,000, $14,600 for single filers, $28,000 for married filing jointly, and the $10,000 cap on state and local income tax deductions, only 10% of tax filers are itemizing their deductions. So while cash donations are helpful to the receiving organization, they don't have a positive impact on your tax liability, just on your heart. And this underscores the importance of exploring alternative and more strategic giving methods to maximize charitable impact and tax efficiency in this current tax landscape. So I'm going to talk about just quick definitions of these three elements we're talking about in this strategy. The first is an appreciated asset. An appreciated asset is a stock or a bond or a mutual fund that you've purchased that's gone up in value. So say you were clairvoyant and you bought Amazon when it first IPO'd in 1997 and was selling at $18 a share. So as of today, it's worth about $158 a share. So that $140 here, you paid $18, this is the $140 on top to make the total of $158. That $140 in there is taxable to you at capital gains rates if you sell that stock. Donating appreciated stock is a tax efficient way of giving you the benefits tax-wise and also benefiting your charitable organization. So when you donate that share, let's say, to a nonprofit, you avoid the capital gains tax that you would have had to pay had you sold that stock yourself. And you can claim a charitable deduction for the full market value of that donation. So that can reduce your tax liability over time, over your full taxable income. And again, this is only of benefit if you have enough deductions to itemize, right? So that's why this is one element of this strategy. The second is donor-advised funds. And put concisely, a donor-advised fund, often called a DAF, it's a powerful philanthropic tool. It allows you to make charitable contributions, receive an immediate tax deduction, and then distribute to nonprofits over time. You don't have to distribute to them right away. So this can be a really great way to offset a particularly high tax year while still being strategic long-term about your giving. So a DAF, it operates as a separate account. It's managed by a sponsoring organization, and donors can recommend grants to qualified charities over time. The third element of this strategy is bunching donations. So this involves consolidating multiple years' worth of charitable contributions into a single tax year to exceed the standard deduction we just talked about and to itemize, or to offset a year of particularly high income. So when we think about combining bunching donations with gifting appreciated assets into a donor-advised funds, we are making a larger charitable contribution into our DAF in a specific tax year with those appreciated assets, which eliminates the embedded gain from our tax liability. We're able to claim a substantial charitable deduction for that year, which could allow us to itemize, again, to offset a high income year. And we have the flexibility to distribute to the charities that we care about over time. So if you think about it, if you were to tell your charity of choice, hey, I'm going to go ahead and give you 2 years worth of donations now, leave me alone, I'll be back in a couple of years. Do you think they're going to do that? No way. You'd be bumped up to a benefactor and contacted nonstop. So a DAF can be a way to allow your contributions to these organizations to stay the same over time as far as they're concerned. So let's look at an example. In a high income year, Alex decides to leverage this three-part strategy to make a lasting impact in an area he's passionate about, education. So instead of making smaller yearly contributions, Alex contributes $50,000 worth of appreciated stock into a DAF. And the stock he originally bought was $20,000. So again, by using this triple benefit strategy, he achieves these three advantages. One, he is Rather than selling that appreciated stock and giving it instead, he avoids the capital gains on that $30,000 of appreciation. He enjoys an immediate tax deduction for the full market value, the whole $50,000 of that appreciated stock. That pushes him over the standard deduction and helps offset his high income year. And 3, with the DAF, Alex now has the flexibility to recommend grants to various education-related organizations over the coming years. So this triple benefit approach, it allows you as a donor to maximize your tax efficiency by combining the advantages of the deductions and the DAF and the appreciated assets. If you want to learn more about charitable giving, there is a blog where I have gone on about a few more details. You can find the link to that down below, and I'd love to talk about it. If you want to talk through your unique strategy, don't hesitate to reach out. Thanks for listening.